Hi everyone, and welcome back to another portfolio update. So right now I'm sitting at $134,411, which is a decent sized higher since the last update. I'm actually up now about $8,500 or 6.75% when comparing to my net deposits, and also up on the principal as well. So, those added dividends have also really boosted the performance. So, um, the thing that is a little different this month, though, is my yield has dropped to $377 for this month, which is um, a bit lower than what I'm used to. Like I was getting over $400, and it comes with a change I made to my portfolio. So I actually swapped out um, three covered call ETFs that I had previously, which were HDIF, HYLD, and HDIV for these two covered call ETFs instead, ESPX and ETSX. And there's a few reasons. I'm just going to pull up my notes here. So the first reason was lower fees. So I'll just show you here. ESPX. I was just on their site. The MER for this is, and I'm using the hedged unit, so 0.68% versus HYLD's MER of 2.4%. That's that includes the cost of leverage, and we'll get into that. But without leverage, 1.15%. So I'm significantly reducing my fees by switching to ESPX. Um, yeah, I was able to actually decrease the overall portfolio MER from 0.73 to 0.28% as a result of this change. So actually, if I just open this hidden tab here, I have the MERs of all the, and this is just your management expense ratio um, for each of the funds. So VFE is the lowest at 0.09%, and we can see ESPX and ATSX here are the higher ones, but that's to be expected with a covered call ETF because they are employing an options overlay on the portfolio. So, but these are the cheapest that I could find. Like I was amazed by how low the fees were for ESPX and ETSX. It's actually amazing how low their fees are compared to other products, even just HYLD, for example, like being over two, like well over 2%. So I was able to save, yeah, I was able to go down from 73 basis points to 28 basis points, and I'm actually really happy with that number because that's only 4 basis points higher than an asset allocation ETF like VEQT. So, I'm gonna have covered call income coming in every month, and having a fee that's very comparable to an asset allocation ETF. So, uh, that was the first reason. The second reason was index tracking and simplicity. So, ESPX is just the S&P 500 with a covered call strategy that writes call options on up to 33% of the portfolio. And it's an active strategy. So, what I really like about this is that it's not a passive strategy. If you had, for example, a market crash, let's say there was like a 20% correction in the market, and now the markets are rebounding, just like COVID, for example, like that huge rebound that was happening. Well, you wouldn't want to write covered calls during that period because you'd be giving up upside during like a really like sharp bull market recovery. And so they would not write options when something like that is occurring, and they're actively writing them up to 33% at the discretion. So they can write a lot less than that. They can only write up to that. So that's really nice. And they're actually just holding. So I'll just show you here. They are holding IVV, which is another S&P 500 ETF, just like VOO on the US side. And then the rest of the companies inside of the S&P 500 are just held beyond that. So we're writing call options on either the individual companies or the ETF itself, the S&P 500 ETF itself. So yeah, it's very simple. They're not deviating from the index. It's just the S&P 500, and for the TSX, it's the TSX 60, which is just the top 60 uh, companies in Canada, and the S&P 500, if you don't know, is just the top 500 companies in the US. So yeah, so they're just so and if I compare that to something like HYLD, so um, they just have this is a lot different. They're holding multiple funds that like are completely unrelated to the S&P 500. So like on HYLD site, for example, they're talking about how HYLD has performed similarly to the S&P 500. They use it. They're constantly comparing themselves to the S&P 500. But then you go to their holdings, and they've got a bunch of NASDAQ funds, Russell 2000 funds, gold. So yeah, so the QMAX, they've added its like more like your technology stocks. Then you've got a NASDAQ fund here in JEPQ. You got another NASDAQ fund in QQCC. They used to hold QYLD in it. They have SMAX, which is sort of like um, this one's really concentrated. It's not an S&P 500 fund. It's really tech heavy too. So I didn't like that either. And then they have JEPI, which is sort of an S&P 500. Not really though. But it's sort of tracking that a little bit. Um, and then you've got USCC, which is again another sort of equating to an S&P 500, but it's not the S&P 500 exactly. So they're holding NASDAQ 100 funds inside of here, which are a lot riskier than an S&P 500 fund, just because of the sheer amount of tech exposure you're getting when you're buying the Nasdaq. So yeah, like this is also a fund of fund ETF. So they're charging their management fee, and then they're charging the fees of these underlying ETFs that are not in-house. So you have Hamilton US equity yield maximizer ETF. They're not paying any fees on that because it's besides the additional levered management fee, but not on the original, like the non-levered part. Um, so there's that, but then you have a third-party ETFs like from JP Morgan, like JEPI, or the Harvest ones coming from like HHL here, or the Horizons ones. So they're paying other fund managers inside of their own fund. So I didn't like that, and that goes hand in hand with the first part, which is lowering fees. So um, yeah, so that's a significant fee reduction for things like that. And then, yeah, they're just sticking to the S&P 500 and the TSX 60, which is very simple, bread and butter. And another sort of comparison we can make, because HDIV, sorry, if I just go here, um, they're comparing themselves to the TSX 60 with this fund. So think of like HDIV and ETSX as being comparable, and then ESPX and HYLD being comparable. And HDIV, it's had pretty good performance. It's here they're showing how it's outperformed the S&P slash TSX 60. But this is deceiving because what they have in this ETF is they have a US technology fund inside of it, Harvest Tech Achievers Growth and Income ETF. So this is like literally NASDAQ tech. And what's supposed to be, they're comparing themselves to the top 60 Canadian companies, but they've got a US technology ETF, and are boasting about performance. Like, because you can see like like the US tech has really, really recovered this year. So that's what's, propelled it up. But, it's not really a fair comparison because it has nothing to do with the index they're trying to track. So I don't, while it is a good fund, like it overly complicates things in my opinion. And again, you have the same problem where it's holding a fund of funds that are third party, like NXF, CI Energy. So yeah, and HDIF, it's not like HYILD or HDIV where I actually hold all of their own funds, but yeah, the management fees are pretty abysmal too. They're like over 2.4% as well. I think there's 2.42 when I looked at the last report. So yeah, those kind of go hand in hand. So index tracking, very simple, just S&P 500 with 33% covered calls, TSX 60 with 33% covered calls versus what's going on here with HYLD and HDIV is just too complex in my opinion. And you've got leverage and covered calls, and I don't think this is a good idea. So these funds aren't leveraged. They're not borrowing money to try and increase the yield and performance. They're just That's it. You just like any other security, you're investing within your means versus HYLD and HDIV actually and HDIF use modest cash leverage of 25% to enhance the yield and growth potential. So you have that 1.15% MER, but then the cost of the leverage is applied as well. So they you have a lot more volatility because you have 25%, move 25% more in either direction. So if the market goes down by 10%, HYLD and HDIV will go down 12.5%. So you magnify your downside by employing leverage, and you have all the added costs of borrowing when you employ a cash leverage strategy. And then when the markets rise, like we saw last year, or sorry, they dropped first, then they started rising, like you've seen last year and this year. Um, with covered calls, you give up some upside depending on the portfolio coverage. So in ESPX's case, it's 30 up to 33% if those call options are exercised, and that's where like the price of a stock rises beyond the strike price, and you give up any growth on the upside from there, but you collect the option premium. So there's with ESPX, you still have a lot of room for upside potential versus with HYLD, some of the funds are writing them up to 50%. But when you use leverage, you're magnifying your downside, but and also magnifying your limited upside. So I don't think leverage is a good idea in that case. And you could see case in point is HYLD, where it's significantly lagged the S&P 500, as you can see here. And this is with NASDAQ exposure. So I'll just show you quickly on Koifin. Like if I look at QQQQ, which is the NASDAQ 100, like look at how much that's up this year, 43%. Like the S versus so QQQ 43%, and then yeah, you see the S&P 500 is up 16% in the same time period. This is this includes some NASDAQ exposure, and it's still underperformed it. So you can see here, you're magnifying your downside and you're magnifying your limited upside, but the way the way they're doing it is just it wasn't able to catch up as fast. And if I plot HYLD's performance on this chart as well, you can see, or sorry, not HYLD. You can see it's lagging even year to date, the S&P 500, and also ESPX. So I guess that leads me to my next point, since I'm already on performance since inception. So we're looking here at SPX. So this is the actual index, the S&P 500. And then you have ESPX. So look, like the performance is hand in hand. Like you've got like almost neck and neck returns with these two funds, and covered calls typically underperform during a bull market, and while this is almost a bull market, it had to be like 20% to be a bull market. You could see like ESPX, the way they've been actively managing it, limiting the covered calls up to 33%. You've got very similar performance, which is great. And then as far as the ETSX and the TSX 60, there is no TSX 60 index on Koifin. That'd be nice if they could add it eventually, but the best indicator of that like baseline ETF I could use is XIU, which is actually I believe the oldest ETF in Canada, which is kind of cool. And you can see ETSX, neck and neck with it. So these two funds, like the performance since inception has been great. And I've been wanting to pull the trigger for a while now. I've kept my eyes on these funds, and I finally decided to do it. I took the monthly income hit for now, but I really expect with the combination of lower fees and all the benefits that I've already described, like it's a better long-term play for me. So, I've got the growth portion of my portfolio. Those are the funds in green, and then the blue is the income stocks, which are income ETFs, which are ESPX and TSX now, that are drawing in like large amounts of monthly income. So that's That's my strategy going forward, and I'm really confident now with where I'm at with my portfolio. Like, I've always thought, like while I was holding the H funds, like that I was there was something like inside of me just thinking about like that 25% cash leverage, though all those extra fees always, that I was like, man, I don't want to I don't want to deal with that. And when ESPX and ETSX came along, I was like, oh, this is a great idea. But let me see the performance for a little bit. I don't want to make an impulsive decision. And I've seen their performance now for a bit. I've been tracking it in Koifin, and I'm confident to say it was a really good change for me. So yeah, I made that change, and I'm really happy with where my portfolio is. I don't expect like any changes for a while now, like other than the R the RSP adding VOO next year. Like I'm don't think I'm going to be adding any more funds or swapping any more funds unless I can find, something with better fees. But for the most part, I think we're good, and this is a really confident change in my opinion. So yeah, so that's uh, that's about it. So yeah, thank you for watching, and I hope you enjoyed some like learning a bit about these new funds that I've swapped to and a bit of my reasoning behind it. And maybe you can consider that for your own portfolio if you agree with a lot of my points. And yeah, let's I'll see you in the next one. Thank you.